Hello everybody, what's going on? So few big leaks are coming from NIO's end. Look at this chart circulating right now across the community. If these projections hold up, we are looking at one of the most significant quarterly turnarounds for NIO in the history. Wall Street currently has Q2 2026 earning release slated for early September. The consensus analyst estimate sits right around a revenue target of $4.70 billion to $5.09 billion, with an EPS loss hovering between $0.04 and $0.05. Mainstream analysts are projecting 4.87 billion in revenue and EPS of minus 0.07. That alone represents substantial year-over-year growth. But independently, community models and detailed delivery data tells a completely different story. If we look at the raw delivery figures combined with average selling price calculation, NEO could beat both revenue and EPS consensus by a massive margin, potentially pushing revenue close to 5.38 billions or even 5.8 billions if early half year revenue estimates hold true. That is the reason why we are tearing down every single variable: the Q2 delivery numbers, the multi-brand ASP breakdown, gross margins, and why the fundamental story for NEO is turning aggressively bullish. Let's ground this analysis in the official hard data we already have locked in. For the second quarter of 2026, NEO delivered 107,000 vehicles, representing a massive 49.4% year over year increase. To put that momentum into perspective, June alone hit 40,500 vehicles delivered, a 62.9% spike compared to last year. What makes this volume incredibly bullish isn't just the overall unit growth, it's execution of NEO's multi-brand strategy. Look at how the June delivery breakdown shakes out across the portfolio. NEO core brand delivered 21,900 units, maintaining dominant luxury market share. Onvo brand 11,700 units, capturing the mass market family segment. Then we have the Firefly 6,946 units, expanding high-end compact urban EV adoption. Onvo and Firefly together now accounts for 46% of monthly deliveries. NIO is no longer just a single luxury brand fighting for high-end buyers. It has transformed into a multi-tiered EV ecosystem scaling across every price brand. Furthermore, flagship vehicles are setting historic benchmarks. The newly launched ES9 hits 10,000 cumulative deliveries within its first 30 days, setting a record for premium battery electric vehicles priced above 500,000 RMB in China. Meanwhile, the all-new ES8 crossed 120,000 cumulative units. Volume is exploding, no doubt, but volume is only half the equation. Revenue depends on the average selling price ASP. Let's talk you through the math shown in featured breakdown. If we take the total Q2 delivery total of 107,300 to 107,600 units and map out the blending of average selling price across the portfolio, the core new brand carries an estimated average transaction value of RMB 400,000 plus. Onvo average around 248,000 and Firefly average around RMB 122,000. When you weight these across total quarterly units, the blended average selling price sits around 334,000, around 47,000 USD. Multi-vehicle deliveries by this blended ASP gives us a projected vehicle revenue of 5.31 billions. Also, add in NEO's growth service revenue, which includes battery swap subscription, software energy uses, and aftermarket service estimate at 590 million, and total revenue jumps straight to 5.90 billions. Even under a conservative model factoring in minor promotional discount, revenue lands near 5.38 billions compared to 5.38 billions or 5.90 billions against Wall Street baseline consensus of 4.87 billions. If NIO report anywhere within this range, it will represent a double-digit revenue beat that algorithm and institutional buyers cannot ignore. Now let's talk about margin expansion and tech moat. Revenue beat means nothing if margin collapse, but NIO is experiencing operational leverage on multiple front. First, R&D and SG&A efficiency. As revenue scales toward 5.8 billions to 5.9 billions, fixed expenses like R&D projected around 300 million and SG&A hovering at 10% of total revenue. Here, I would say that the Wall Street is still pricing new based on legacy cost structures and old loss metrics. The consensus estimate predicts EPS at minus 0.07 to minus 0.04 per share. However, if vehicle gross margin expands due to manufacturing scale and high margin ES9 sales, NIO could easily post an EPS surprise closer to break even or a significantly narrower loss than expected. Historically, when a heavily shorted or under-owned EV stock reports record delivery volume of 49.4% year over year and a double-digit revenue beat, the market is forced to rapidly reprice the asset. We are seeing early signs of an institutional pivot as delivery records stack up month over month. That is the reason why, in the end, I will say that the noise in the market often blind investors to operational reality. NIO is no longer just surviving the EV price war. It is actively consolidating market share in China's premium segment while aggressively expanding its total addressable market through family and compact brands. With over 107,000 deliveries in Q2, the ES9 breaking high-end sales record and revenue model signaling a massive beat over Wall Street consensus, the risk to reward ratio for NIO heading into this Q2 earning hasn't looked this favorable in years. If upcoming earning report confirm these operational metrics, the bull case for NIO isn't just intact, it's accelerating. So keep your eyes on those numbers because that could change the game completely. With that said, thank you so much for being here. See you in the next one.